Silver is trading at $80 per ounce. As of December 2025, this level would have sounded unrealistic only a few years ago. But the real question is not how silver reached $80. The real question is what happens next. In this video, we examine why $80 may not be the peak, but instead a midpoint in a much larger move, and why silver reaching $300 during 2026 is a scenario the market must seriously consider. Silver's rise was driven by persistent inflation, currency debasement, and a global loss of confidence in paper assets. At the same time, the gold-to-silver ratio began to fall rapidly, signaling that silver was entering a leadership phase. Historically, when silver breaks long-term resistance, it does not rise slowly. It accelerates as capital rushes into a market that has been ignored for years. The global economic backdrop is critical. By late 2025, global debt levels are at historic highs. Governments face a narrow set of choices. Tightening policy risks recession and instability, while easing policy weakens currencies further. Real interest rates remain negative across much of the world. This environment has always favored hard assets, and silver in particular has thrived when confidence in monetary systems begins to erode. China plays a central role in this setup. It is the world's largest consumer of industrial silver, driven by electronics, electric vehicles, and large-scale solar expansion. Solar panel production continues to grow, and each panel requires silver with no easy substitute. In recent years, China has also increased silver imports, not only for consumption, but for strategic accumulation. When the largest industrial consumer becomes a long-term holder, available supply tightens quickly. At $80 per ounce, the physical silver market is showing strain. Mine supply growth has failed to keep up with demand. New mines require years to develop, and most silver is produced as a byproduct, limiting rapid supply responses. At the same time, physical inventories are being drawn down across exchanges and vaults. Paper contracts can be created instantly. Physical silver cannot. When physical demand dominates, price behavior changes. History provides context. Silver does not move in smooth cycles. It moves in phases. In past bull markets, silver spent long periods consolidating, then broke out, followed by a short and explosive final phase. In both the 1970s and 2011, silver multiplied several times after breaking key resistance. The largest gains occurred after most investors believed the move was already over. From a technical perspective, a move from $80 to $300 is aggressive but not unprecedented. On a logarithmic scale, projected extensions align with previous silver cycles. The percentage move required is similar to prior terminal advances. This would not be a slow climb. It would be volatile, emotional, and fast. This outcome is not guaranteed. A global slowdown, aggressive tightening, or intervention could change the path. Markets are complex and uncertain. But if inflation persists, real rates remain negative, physical supply stays tight, and China's demand continues, silver reaching $300 in 2026 is not fantasy. It is a scenario grounded in structure, history, and data.